We are getting into it in this episode. How to rid yourself of fear and greed and all the emotions in between. This is the hardest thing to do as an investor, but it's also the most important. We know that being too emotional can be costly for your portfolio. It causes you to make mistakes and second guess your decisions. So in this episode of How to Invest by Julius Baer, we're having a heart-to-heart on how to emotion-proof your investment decisions. Let's go. This is every investor's worst nightmare. Stock markets tanking after a massive shock to the system. This is exactly what happened to the S&P 500 back in early 2020, when everyone suddenly realized that we were in for a prolonged shutdown because of the COVID pandemic. The index dropped 7% shortly after markets opened, prompting circuit breakers to jump into action. Other indexes around the world then followed suit. From February the 19th, 2020, a high, to the bottom a week later, the S&P 500 would decline around 34%. Now, these are exactly the kind of headlines that will get you flustered. And it's understandable. Humans are ruled by their emotions. And you may not even realize that you're under the influence. According to our head of research, even when we know that our emotions could get in the way of a decision, we still fall prey to their influence. And very often, investors find out that the hard way. But if you take a minute and a few deep breaths, you can weather a storm such as a market drop. Markets go up and down, that's the point, and you should expect them to. Taking advantage of this volatility is an important part of investing in markets. And generally speaking, investors are looking to buy low and sell high. But that's tough to achieve successfully time after time. What's interesting is that stock markets have priced in most things like rate hikes, unemployment figures, management changes. They're pretty clever like that. What they don't price in are external shocks, things that are unexpected, things like the coronavirus. Although markets even priced some of that in back in 2020. But here's the kicker. Stock markets recover time and time again. Remember back in episode 3, I quoted 90s Britpop sensation Oasis who had a hit with Don't Look Back in Anger. And the point was that you shouldn't look back to past performances to predict the future. Well, that's still true, but here's the exception to that rule. Looking back can give you some comfort. Zoom out and you can see that the stock market not only recovers every time, but in many cases goes on to new highs. After the global financial crisis, after the war in Ukraine, after COVID-19. Even when you might think that this time it's different, it's really not that different at all. Because at the end of the day, we live in a capitalist economy where wealth is created by entrepreneurial activity, and that activity is helping to finance business, and you're rewarded over time with a return on the capital provided. And when you have a plan in mind, this kind of thing is even easier to ride out. Having a plan is key to any investment strategy. Having a plan and sticking to it is even better. You need to know where you're going and how long it will take to get there. It's pretty fundamental stuff and we already covered it back in episode 1, so do go back and check it out if you haven't already. Setting your investment goals will determine how much risk you're willing and able to take. It will inform your decisions in building a portfolio. But in order for the plan to work, you have to have discipline. And discipline takes the sting out of short-term shocks in 2 ways. Now, not only does it stop you from selling assets at a loss because you have freedom to wait for the downturn to right itself, but it also stops you from then taking on more risk than you're comfortable with in order to make up for any losses that you incur through panic selling. This is crucial. It means that you can afford to ignore the talking heads and the doom and gloom headlines with a view on the longer term. If you stick to your investment goals, then you just have to ride out the short-term volatility. And you do this by not exposing yourself to the details that might make you change your mind. And I appreciate this is easier said than done. This is why investing is so hard. Everyone always thinks that this time it's different. Remember the chart from earlier? It really is. Just focus on the long term. Turn off the 24-hour news flow and look at the parts of your portfolio that have been less impacted by the crisis, because if you're diversified, you'll have that peace of mind. Diversification is key in building a robust portfolio. It protects you from a duff investment or two, of course, and it helps you sleep better at night. But it doesn't end there. Using diversification as an investment approach can also help avoid getting emotional about your investments, because a portfolio that is well balanced and diverse is less affected by swings in the market. And by the way, if you cannot sleep at night because of your portfolio performance, it means that you need to adjust your risk accordingly. Don't forget that diversification can be across asset classes, within asset classes, across industries and geographies, and can even include alternative investments like hedge funds, private equity, or even real estate. Each of these investment types are affected by market conditions in different ways. So when one is down, another could be up. But there is another little something that you need to keep in check, and it's one of the biggest common mistakes investors make. How easy is it for you to admit that you're wrong? It can be tough, it's embarrassing, and it's exactly why people will keep a losing security just because they don't want to admit an error in judgment. Not only that, this is another interesting point, people tend to keep losing stocks and take profits on their winners. So they're selling the stocks that are doing well while keeping those that don't. And over time, this can be crippling. Your portfolio will be heavy in losing stocks with nothing to balance it. A good investor needs to have the ability to cut the losses and extend the profits. And this comes back to discipline, back to having a plan and seeing it through. Now, doing my research for this video, I also came across a handy little tool called breathing. A few deep breaths can go a long way in stopping you from hitting that sell button in a crisis. So take a few deep breaths now as we recap what we've covered in this video. Investing isn't always about jumping on an opportunity. It should be about your own personal goals and timeline, and having the tenacity to stick to your plan even when the going gets tough. What investment questions can we solve for you? Do comment below. And next time, we look at just how costly it can be if you miss just a handful of the best trading days over 3 decades. It's guaranteed to make your eyes water. So make sure you don't miss it by clicking the like and subscribe button, and we'll see you next time.